Hello, welcome back to my network. I'm joined today to talk about gold. It's been a long time coming. I think it's been a couple of weeks since we've spoken about the topic. I'm joined with John Reade, the senior market strategist for Europe and Asia. John, good to see you.
Hi, Peter. Good to be here.
Look, just before we get into your thoughts on central bank buying, the West actually buying a bit more and actually getting more involved in this market and a whole host of other things that might be driving this. Uh, a lot of people probably have seen the Idris Elba interview. They have heard about the World Gold Council, but I want to just to set the scene. What are you currently up to? What is the World Gold Council, and
Sure.
why should we be listening to you?
Okay, look, well, the World Gold Council is a non-for-profit organization that was started about getting on for 40 years ago now to develop the gold market. So we're owned by large gold mining companies around the world, and we do a number of things to try and make the accessibility of gold more easy and more trusted. One of the things that we do is we produce an enormous amount of research and strategy about gold. And I'm the senior market strategist. I used to run the research team as well, but still work very closely with them. We produce supply and demand statistics. We produce a number of reports, not least of which the Gold Demand Trends series, which is a quarterly publication. We've just produced our annual 2024 Gold Demand Trends, which covers both last year and the fourth quarter of 2024. Which goes into all aspects of gold demand and touches upon supply a bit. We also have a number of tools on our website, gold.org, which allows investors, buyers, people who are interested in gold to see how gold performs under certain conditions, drivers, how much gold you might want to have in a portfolio, etc. So everything's free, registration required once, that's all. But we're here to increase trust and understanding about the gold market. And we think once people understand gold better, they'll tend to own more of it. So that's what we are.
Okay, all right, sounds good. Look, obviously, we've just recently hit all-time high gold prices. We're starting to see some forecasts from the likes of Goldman to say that it's going to go higher. I think they're forecasting now around 3,100. How much of this new drive in price do you think is really driven behind, because it's always really been over the last few years around the East and central bank purchasing? How much of that now is still the case, or are we now starting to finally see some inflows from the West?
You're quite right. The story of the last few years has been of emerging market demand, really from all sorts of types, whether it's emerging market central banks accelerating the amount of gold that they're buying, emerging market investors who are buying gold primarily for domestic economic and political drivers rather than reacting to the dollar or US interest rates. From time to time, it's been strong jewelry demand, but not at the moment, not with gold at all-time highs. Those have been the major factors in gold over the last few years. There are signs that we're seeing a turn in sentiment from the West, but it's not what I would say broad-based at the moment. So on the one hand, we've seen inflows into exchange-traded funds, which the bulk of the owners of those are European and North American. We've seen those turn positive around the middle of last year, and that's continued into 2025. But the amount of inflows have been relatively light, but they're not outflows, which they have been for the last few years. So that's a positive. But the larger and probably more important component of coin and small bar investment remains weak in the West, and we haven't really seen much of a turnaround there yet. So I'd say that the Western investor remains, should we say, they're not buying as much gold as perhaps we would expect with the prices at all-time highs. And there are good reasons for that, and those reasons should, I expect, fall away through the course of 2025. We have strong emerging market interest for gold, and then we've had a lot of financial speculation, particularly out of the US futures market, which has really contributed to a lot of the move higher in gold in the last 12 months.
What's the risk at the moment? Obviously, we're in all-time high territory. What risks are you sort of seeing that potentially that there could be a collapse or anything along those lines if tariffs don't come off? Or how are you looking at the risks associated with the current price that it is? Because
Sure.
obviously, usually when you hear all-time high, obviously what goes up must come down usually.
Well, I think we hit 40 all-time highs last year. I haven't counted them this year. I've lost touch with the travels I've been doing, but it's probably 8 or 9 already this year. So didn't come down last year and hitting new all-time highs this year. So just because something's at an all-time high doesn't mean it won't be at another one tomorrow. So that's the first thing I'd say. The tariffs have had a big impact on gold trade and have probably contributed to some of the strength we've seen in gold this year, but it's not the only thing. So to explain a little bit about what's been happening with the fears of tariffs or the risks of tariffs being imposed, it's worth thinking about the physical gold market and how that has had to move to protect traders from an imposition of broad-based tariffs. So in general, the COMEX futures market, which is a very large, important area for people to gain financial exposure to gold, that doesn't see much physical delivery. Typically, investors buy leveraged exposure to gold, but they've been net long on the COMEX futures market for a couple of decades now, 99% of the time at least anyway. So they're long gold futures, and it's a futures market. There has to be a short against that. That short is typically banks and other financial players. They're short futures, but they're not short gold overall. They'll be running long gold positions in London against those short futures positions and are perfectly happy to do so. Because if you need to deliver into those futures, you can relatively quickly get gold from London, turn it into the right size of bars, ship it to New York and deliver it into a COMEX warehouse. And unless you're worried about COVID interrupting the ability to do any of those legs, which did happen in 2020, you're happy to keep your gold balances in London where they're more useful. You can do more things with them and it's cheaper to store it as well, I believe. So what's changed is if you start to worry about the imposition of broad-based tariffs, you won't be able to ship it to the States for whatever it is, $1 an ounce or whatever. You might have to pay $300 an ounce as a tariff. So when these concerns started to develop in December last year, so really following Trump's victory, then people did two things. First of all, they tried to cover their financial exposure by selling London, buying COMEX. That drove COMEX higher and drove the relationship between the COMEX price and the London price higher than it would normally be. The other way you can hedge yourself against the potential for tariffs, though, is to take gold, the balances you hold in London, ship them out, turn them into kilobars, ship them to New York, deliver them into COMEX warehouses. So we're close to all-time high levels of COMEX inventories in the US, and we've seen about 650 tons of increase in physical gold stocks in COMEX inventories in and around New York since the beginning of December. Now, that's a lot of gold that's moved in a short space of time. If I look at the size of positions in the COMEX futures market and what could conceivably be delivered against, that looks to me as if it's perhaps enough gold has headed to New York. And indeed, the spread between COMEX and London has come back much closer to where it normally would be. But moving that gold has had consequences because it has reduced the amount of gold in the London market, not by much, but it has reduced it. And more to the point, it's reduced the amount of gold that's immediately available to be used in the gold market. Some of that gold is held in London, is held in ETFs, and ETFs don't lend their gold out. Some of that gold's held by central banks, and some do lend that, but not all. And what's happened rather, is that the gold that is theoretically available to the market is at the Bank of England, and the Bank of England now has a queue for gold to leave its facilities, and that queue is spoken about as 4 to 6 weeks. I've seen various comments, and because gold's stuck effectively in the Bank of England and can't be used in the market, the cost of borrowing gold increased a lot, particularly at short tenors in January and February, but has now started to come down. So, and that's the other side of the equation as well. Yes, there's a queue at the Bank of England, but gold comes out every day. And based on what we've seen in terms of a decline in the cost of borrowing in the last few days, it would seem that the UK market's returning to normal. So it's been a lot of excitement in the gold market. It might have had a bit of an impact on the gold price, But I'd say it's not the main driver of gold higher this year. I think it's more the concerns around what all the pronouncements from the new US administration is going to mean. I can't remember a period when we've had more uncertainty about more aspects of what the US government's going to do in the next, well, I was going to say next 2 years, but it could be the next 10 minutes, certainly from what's been spoken about. And that risk and uncertainty has been helping gold. Now, it's one of the main drivers of gold, and we shouldn't be surprised that this high level of risk and uncertainty has resulted in the gold price trading higher this year. Are there risks? Well, of course there are risks. There are always risks. We could see the US administration calm down a lot in terms of some of its more radical pronouncements, and broad-based trade deals signed and tariff agreements put in place, and then the world can focus upon economic growth and peace and prosperity and things like that. But that doesn't seem very likely in the short term. There's another thing, of course, that could happen. There's been quite a lot of chatter from the Trump camp. So not necessarily people in the government, but people around it and reportedly close to Trump about the US's gold reserves themselves. There's talk about auditing the Fed's gold, particularly the gold held at Fort Knox. And look, any time that the US government or people close to the US government talk about the US's gold, that should be considered a risk in the market.
Like we were saying, a lot of this really was Eastern buying, and now you're starting to see obviously Trump policies come in and really people try and provide a hedge towards that. Like you were saying that, how much does the US dollar now have an influence? And I get is one of the upside cases that we could see a weaker US dollar. It's one of the only ones that sort of held up in global currencies. Is that some serious upside there still to become from the US dollar if it can go down?
In theory, yes. I mean, I would say that the impact of traditional financial market drivers on gold, particularly the US dollar and US interest rates, has had less of an impact on the gold market in the last couple of years than it has done for a while. And I think that's because of the importance of the emerging market investment trends that we've seen, and also the central bank buying as well. In general, though, Rule 101 in terms of gold trading is a weaker dollar means a higher dollar-denominated gold price. Similarly, a fall in interest rates, particularly real interest rates, tends to mean a higher gold price. So if both of those factors were to materialize this year, it would certainly present tailwinds towards gold. But I'd be less certain about it now than I would have been in previous years because of the unstable nature of those relationships that we've seen over the last year or two.
Okay, and what scenario could you foresee where emerging markets potentially feel comfortable with their gold holdings? I've seen some reports saying that they should really be getting up to 40% of their backing by gold. That some of them are nowhere near that. And you've got a figure in mind in terms of what the goal is with the emerging markets, especially places like China, Turkey, Russia, etc., in terms of where they want to see their gold holdings? And
No, I don't think there is one number that they're looking at. I mean, there's first of all the work that I've seen, and this has been done by a number of different organizations over the years. The numbers that I've seen would suggest 40% would be too high, to be frank. The way I think about it, emerging market central banks have on average about 10% of their reserves in gold. Developed markets have about 25%. There's certainly room for emerging market purchases to continue for quite a while. What's the right number? It's difficult to say. I mean, I take the example of when the European Central Bank was formed. They deliberately put 15% of their reserves in gold, and that climbed as the price climbed. So that's not a bad starting point. So on that basis, there's upside potentially for some years to come, even at the current rapid rates of purchases that we've seen from central banks over the last few years.
okay, obviously, when you were talking about the Trump implications in terms of pronouncements he's made and potential fears of tariffs, so therefore you might have import or export tariffs on gold going into the US, which obviously has caused a bit of a frenzy. That's urged on more Western interest in the short term, you'd imagine, right? But in terms of Trump's policy making in the East, if he's able to get a peace agreement in Ukraine, the way that he's talking at the moment, obviously a lot of the Eastern purchasing, like we were saying, was really because they froze Russian assets, and there was a hostility there from the West towards the East, and a fear of weaponizing the US dollar against them, and trying to get away from it. Under Trump, do you think the East are a bit more at ease? Can they feel a little bit more settled in potentially not having to buy so much gold? Is that an angle potentially?
I mean, one of the things that I think seems likely this year or the next 2 years is we may see an end to some of the hot wars that have been taking place. So in other words, the conflict between Russia and Ukraine, potentially calming down in terms of the Middle East. But I don't think anything is really changing in what I would describe as perhaps as the Cold Wars, or more the economic competition that's taking place between the United States and some major developing markets. So I think people will remain nervous about weaponization of the US dollar. After all, it was Trump that started it, with threats of sanctions, etc. And the Biden administration obviously sanctioned, or was amongst a group of Western countries that sanctioned the Central Bank of Russia. I mean, I think, to be honest, the genie's out the bottle now. I think that reserve managers at central banks and their governors and the politicians that stand above them all realize that there is a risk in holding assets that could be frozen by the US and other Western central banks. And I just, because peace is imposed upon Ukraine, I don't think that changes anything, to be honest.
Okay, obviously Putin last year at one of the BRICS summits said it now wasn't the right time for a gold-backed currency, but that to me, you're sort of listening to that thinking, well, that sounds like there probably will be a time where they are contemplating that. Is that something you give any credit to at all?
Not really. I think that the countries which are not natural allies of the United States and the West, I mean, they may be enemies, they may be just not aligned. They probably would like a currency which they could trade amongst themselves or use to settle trade between each other. And that wasn't the US dollar or anything to do with the US dollar payment system. And that's perhaps some of the reasons we've heard talk of a BRICS currency or a BRICS plus currency potentially backed by gold and other stuff. I wouldn't be surprised if that doesn't happen. But the return to a gold standard or backing any currency by gold, I mean, you only do that as a sign of profound weakness. Any reason you back your currency with anything else is because people don't trust your currency. So I don't think we're on a point of even thinking about a return to a currency-backed system or a gold standard anywhere in the world. Could it be something that's introduced as to back a trading currency between the BRICS nations or the not natural allies of the United States? Could do, I suppose. But I think this is more a political conversation rather than an economic one. And certainly when we speak to central bankers, and we've got a team that does nothing other than speak to central bankers, all of the stories that you hear in the media are news to them. There's certainly no preparations going on behind the scenes that we're aware of, or indeed that they are too.
Yeah, I think the only thing with what you're saying there with the BRICS side, creating a gold-backed currency, in a way that would make sense, because I'm not entirely sure if all of these BRICS nations actually trust each other, and they probably do trust gold. So it wouldn't make sense in that respect.
Yeah, but where would you hold it? Where would you hold it that everyone trusts it? Because you couldn't hold it in Russia or China, would you? And that's one of the things. If you're going to have a gold-backed currency, you need to think about where your delivery location is. Where are you going to clear these trades, these differences? It's not going to be the Bank of England, that's for sure, and not just because of the queues getting the gold out of there. So you'd have to think about where you could do it, which would be, both trusted by all the participants, but sufficiently insulated from influence of the United States and its allies. So that's a tricky one, and I have been giving that some thought. I haven't come to any natural conclusions, to be honest.
Would something like Saudi Arabia be an option? Obviously, they're
What, with a US security umbrella? Yeah, maybe.
well, but they're also moderating the talks for Russia and
Who knows? Look, it's the Middle East is one potential location for this. But again, I don't think that they are without. I don't think the US is without influence in that region. I think it's fair to say.
yeah, that is definitely fair to say. You were just mentioning there you have a team that talk to central bankers non-stop. What's any news coming out of the central banks? Anything different from what you were hearing last year?
We're about to start our annual survey where we survey all the central banks and that we have contacts with, which is basically everybody that isn't sanctioned. And we ask them what they're thinking about gold for themselves, what they think the community's doing, then technical stuff, where do they store it, what sort of gold do they buy, where do they buy it from, etc. And the results of these surveys over the last few years have seen clear trends of increased expectations of further central bank buying from the community. And I'd be very interested to see what they think this year after another year of plus 1,000 tons of central bank purchases. So we'll be releasing that report probably around about June, I think it comes out. But we're interested to see what they say there. I haven't heard any particular changes. What I would say is there's been a growing number of central banks that are interested in adding gold to their reserves, not least through domestic purchasing programs. So in other words, central banks buying gold from locally sourced artisanal and small-scale mining. It's seen as a way of capturing some more of the benefits of that mining to the country, so it doesn't just get smuggled across the border. And it can be a contributor to improving standards at some of these small-scale mining. So we're getting a lot of inquiries from that, and I'd expect to see more central banks buying probably small, not always, but probably small amounts of gold as a consequence.
Okay. Is there also an angle there, I guess? Because a lot of countries, especially in South America, you talk to government officials in, say, Colombia or another place like that, they don't really like artisanal mining whatsoever, and they don't want us to buy. I know other countries have different views on it, but is there a view there that obviously, like you're saying, that can support the local community, but I guess they can probably get a discount on the gold that they're making in country as well, can they?
I mean, it's a huge topic and it's very nuanced and has very many different angles to it. What I would say is, with gold prices where they are at the moment, and with artisanal mining pretty widespread in Latin America, in Africa, it's very hard to see how it's going to stop. What you can do, though, is you can try and make it less bad. In other words, cutting out organized crime from the picture, cutting out the use of mercury, maybe better safety standards, maybe making sure that more of the benefits of that gold mining accrue to communities in the country. So we're doing a lot of stuff in this area. There's no one secret solution to fixing it, but having central banks, setting up domestic purchasing programs, which has, been done for many years, for example, in the Philippines, can help and can help make it less bad. I don't think anybody really likes, any country, any government really likes artisanal and small-scale mining, and for good reason. But the better you can make it, the less reason they have to object to it.
Yeah, okay, that makes sense. How much does the price of gold deter central banks from actually buying gold now that it's starting to reach the $3,000 mark? It seems as though the price could reach any level and central banks just keep buying. Is that true? Is there a price limit where central banks turn around and say, actually, it's not worth it at this point?
It's difficult to see. I mean, we don't actually observe, obviously, the trades in the market, because we're not in the gold market. We're merely observers of it from the outside. Based on the statistics that we've got, the fact that gold hit 40 new highs last year didn't stop them buying a near record amount of gold. What we tend to see, well, what we tend to hear about in the short term is that when the gold price goes up rapidly, as it's done this year, then central banks might step back from the buying a bit. But in general, I'd say that the allocations or the increased allocations to gold are made at a very high level, maybe governor level, maybe at the politicians level. And the reserve managers then have to basically execute that order. They don't want to pay the highest price that's ever been paid for gold. But I suspect that they'll be sitting beneath the market, buying on dips. And if we were to see a correction, and you do get corrections in gold, then I suspect that the central banks will come in and provide a bit of a floor under the market. One of the things that really has characterized the run in gold that we've seen since the beginning of March in 2024 is the corrections have been really shallow. When I look at all the indicators that I've looked at for decades now about gold, and I think, okay, gold's going to have a decent correction here. Instead of falling $200 and lasting 4 to 6 weeks, it falls $50, $80 and lasts 10 days. And that's a clear indication to me that somebody's in the market there, beneath the market buying. From time to time, it's jewelry buyers. But jewelry demand was down last year because of high prices, so they don't have as much influence as they normally would. And I think central banks are good candidates of sitting beneath the market and stopping the gold price from correcting further. Not that they're trying to support the price, but just that their buying actions are doing so.
What's the current level of supply that we're seeing from the gold miners globally versus the demand that we're seeing today?
Well, according to our stats in gold demand trends, and I do encourage all of your listeners who are interested in the gold market to go to our website and download it. We reported that mine production hit an all-time high in 2024, up 0.5%, I think it was, on the previous all-time high set back in 2018. But, and here's some caveats. First of all, when it comes to in an individual quarter, we report gold demand trends before all the mining companies have reported their production results. So there's always room for disappointments, or hey, maybe sometimes mining companies might exceed their expectations. But in general, I think the risk is that there'll be some downgrades to that first estimate that we made for Q4 24. So we may not actually have hit an all-time high last year, but we'd have been very close to it. But if you think that the previous all-time high was in 2018, what it shows you, I think, is that gold mining companies have been unable to materially expand production to take advantage of higher prices. It's not that they don't want to, but a limited number of new mines and projects coming on stream, and as mines get older and run out of reserves, they tend to close. So this is an industry which is struggling to grow. And I think the biggest factor why it's struggling to grow is a combination of stability in countries where there's probably gold to be found, but you don't want to invest in. And on the other side, countries where you are confident about being able to find gold and you're confident in the governments behind it, getting the environmental permitting to start a new mine is taking longer and longer. So those two combination of things is permitting and political stability, I think, are preventing the gold mining industry from expanding to take advantage of this increase in price. And if you look at where we are seeing new mines coming on stream, it's in very safe jurisdictions like Canada, for example.
Yeah, no, agreed. You're either at risk of the mine taking forever to get into production, or you're at risk of losing it a lot of the time. It's a harsh reality. I was always under the impression, though, I think this would have been from years and years ago, though, when I was doing research on gold. I remember reading that the supply of gold, you could essentially turn it off and on, but it wouldn't really have an overall impact on the price of gold. Because it's such a small portion of the amount. I think it's about 1% of the total gold that we've ever produced.
Yeah, I mean, some numbers behind that. I mean, new mine production's about 3,600 tons a year. And the stock of gold that's been mined since antiquity is about 216,000 tons of gold. So the stock of gold is increasing 1.6% per annum, roughly, something like that. So you're right in that you could stop mining gold and we'd still have plenty of gold. But if you were to stop mining gold everywhere, you would have an impact on the price. There's no doubt about that. But it is not a commodity that we're about to run out of, even if we stop mining. It's one of the reasons why it's not declared a critical mineral by many countries. A few, yes, but not many. Because even though gold's use in society is essential, not just for investment and jewelry, but in the small component that goes into electronics demand, about 7% of total demand a year goes into that sector. And look, we would really miss it if we didn't have any gold available. But you don't need to mine gold to get that. So you're right. Gold is a very unusual commodity in that sense. If you compare it to, say, crude oil, you take crude oil out of the ground, you put it through a refinery, turn it into products, and then destroy those products through use. In the case of gold, you don't. It never goes away. You lose some of it from time to time, but then again, they keep finding Spanish treasure ships off the coast of South America, so sometimes it comes back as well.
Just the final thoughts, I guess, in terms of what are you looking out for most over the next couple of months, or even throughout the whole of 2025? What are the key drivers that you're keeping an eye on?
Well, politics, particularly US politics, is going to be really important. Trump and his administration say a lot. What actually can they get done? That's the first thing. The second thing, as I would say, is US inflation. It's probably one of the biggest things that I'm paying attention to, because there is no doubt that lower interest rates in the US and in the Western markets would help investment demand towards gold. I guess the final thing is how the Chinese economy is going. We've seen weakness in Chinese jewelry demand last year, partly offset by strong investment demand, but the jewelry market's bigger than the investment market. So any signs of recovery in the Chinese economy and greater consumer confidence and warm fuzzy feelings towards the world could see them buy a lot more jewelry. And admittedly, they may buy less investment gold, but as I say, the jewelry market's normally bigger. So those are probably the three big things I'm looking at the moment.
Awesome. All right, John, thank you very much for your time.
Thanks, Peter.